And and just like that, it seems like the rally is over. Didn't it feel like we were just getting used to this rally? But here we are. Rally looks like it's over. Big down day in the markets, worst day since June in about 2 months. I'm just checking over here to make sure the sound is coming in. Let me know, guys, how I sound, if I'm coming out nice and loud and clear. Thank you for joining me. I'm Mitch Goldberg. You're watching my live stream. Be the boss of your money. It's about helping you to become your best financial version of yourself. We talk about a lot of things. We talk about investing, preparing for the future. We talk about the stock market a lot because a lot is going on. And the stock market, to me, is fascinating because it is a reflection of you and me and everybody else. It's a reflection of what's happening around the world, of what people really think. Sometimes the market goes up in times of global stress, and it makes investors look very apathetic. And sometimes it's very cold, and the market just focuses on numbers, not the human toll. We talk about these things. Today, though, it does look like finally things are starting to weigh on the market. And I'm not talking about the horrible war in Ukraine. I'm not talking about possibly, possibly China's forced uh, taking over, potentially taking over Taiwan, which, by the way, about 65% of all semiconductor chips are manufactured in Taiwan, and about 90% of all what's considered high end chips are manufactured in Taiwan. So the whole global economy would come to a screeching halt without our semiconductor chips. I'm not even talking about those things. I'm just talking about Jackson Hole, Wyoming, this week, when on Friday, this coming Friday, Chairman Jerome Powell, chairman of the Federal Reserve of the United States, Federal Reserve Bank of the US, is going to give his take on inflation, um, what the Fed thinks about inflation, and what he wants to do to tame inflation. And we got used to this idea that inflation has peaked. I am still used to that idea because I still believe it. But now the idea is that inflation will come down, but it's going to come down so gradually that the Fed still has carte blanche to keep pushing up interest rates. So instead of thinking we're past the halfway mark for the Fed to raise rates, now we're not past the halfway mark. We're still ahead of the halfway mark, which means there's a reevaluation coming to us in the stock market. In particular, the high flying stocks that just rallied the most since the June lows are now getting hit the hardest. And I'll show you a list of meme stocks, but it's meme stocks, it's tech stocks, the stocks you would expect to get hit. Interest rates are starting to creep up on the long yield, on the long bond. 10-year yield is over 3%. We've got a lot of things to contend with. But the important thing is that you smash the like button while you're watching this. If you feel I deserve a like, then go ahead, hit the like button, or a heart, or an applause, a wow, whatever the reactions are available to you on whichever social media platform you're watching this from. If you have any questions, please hit me up in the comments. I love hearing from you. It's the best part of doing this. And your questions, no doubt, is the best part of doing this show. I love to hear from you. So go ahead, hit me up with a question in the comments. Words of wisdom, just saying hello. That's always nice as well. I'm going to roll the intro. I'm going to show you some things, in particular, my list of meme stocks, to give you an idea of what's happening today. All right. Thank you for joining me. I'm Mitch Goldberg. We're just getting started. We're talking about the economy, the market. I don't know how it is where you are. By me, it is, well, we're all in the end of August. In my neck of the woods, that means things grind to a halt. Where I live, school doesn't start until after Labor Day. So basically, Long Island is like a ghost town. You can practically see the tumbleweeds blowing through the parking lot, and I'm in a big suburban office complex. So probably next week I'll be taking off from doing the live stream, but a couple of important things to consider. First, we have James. You deserve the likes and support. Thank you so much, James. I really appreciate that. Means a lot. By the way, the recent pictures of your kids are absolutely adorable. Great picture of the boys. So, thank you, buddy. And we're talking about what's going on today in the market because instead of worrying about the important things, we're worried about Friday, Jackson Hole, Wyoming, where every year the Federal Reserve has this big meeting and they invite central bankers from all over the world, from Europe, from Australia, from Japan. I don't think anybody from Russia is going to be there this year. I'm pretty certain of that. But they talk about global economic policy, interest rates on a global basis. And the overwhelming feeling is rates have to go higher, which throws markets and economies off globally. So I'm hearing all kinds of things. Some people think we're going into a bad recession. Some will say we're going to skirt by it. Some people say we'll have a mild recession. The calls are all over the place. In days like today, it reminds me to think. It reminds me to think about being a long-term investor. I personally don't get worked up on down days. I've been doing this a long time, over 30 years. So if days like today rattled me and made me nervous, imagine what I would be like. I don't think I'd be able to survive being in the industry so long, but I know we always come through it. We get out of it. Keep in mind, individual stocks don't always recover, but the stock market averages have always recovered. And by the way, you know what I'm going to say now, right? You can't invest directly into an index, but you could invest into a security that tracks or mimics an index. Just have to get that out of the way. So let's take a look at how things did today. Pop myself up in the corner here. The Dow down 643 points. That's a pretty substantially down day. Nasdaq down almost 2.6%. S&P down 90, down over 2%. These are pretty big down days. Not the biggest we've seen. And, sometimes these are one hit wonders. It remains to be seen if this continues. Gold continues to come down, showing investors that gold is more of a monetary phenomena than an inflation hedge. Oil continues to stay around 90. 10-year yield is moving higher. And the euro US dollar a little weaker. VIX above 23. It's above 20, obviously. So that is helping push stocks down as well. I was just asked, a friend of mine asked, what do I think of the 10-year over the next week or two, over the very near term? Now, so I was just asked by a friend of mine where I think the 10-year yield goes over the next week or two. First, that's really speculation to make a call on where interest rates are going to be over the next week or two. But I'm willing to play. I'm willing to give you my thoughts. I think the 10-year yield looks to be a little higher than it is now. Why is that? The Fed is getting set to raise rates more. People are concerned that the Fed wants to taper its balance sheet a little bit more, let more bonds roll off. And all of a sudden, the flight to safety that you would expect the bond market to get when the stock market goes down, it's just not really evident at the moment. So yields probably go a little higher. Inflation worries are back on the front burner. And what we thought would be the point where the Fed is closer to the end than the beginning of its rate hiking cycle, we are now closer to the beginning than the end, at least as perceived by us, by your fellow investors. So that's what we're looking at. The bond market, okay, was basically the whole yield curve rose a little bit, but still maintained a negative yield curve between the 2-year and the 10-year. See, the 2-year is at 3.3. I'm just going to go by the first two numbers, 3.3, and the 10-year is 3.0. Okay, so about 30 basis point difference. It's pretty substantial. It should be the other way around. The one that I have highlighted, that should be higher than the 2 year, but it's not. And when that happens, we call that an inverted yield curve. Do we want to see an inverted yield curve? No, we really don't. I have to just say a quick shout out to Menly. How are you, Menly? Nice to see you. Um, so we want to see that change. We want to see the 10 year higher than the 2 year. And what it means is it's an indication that investors don't have a lot of confidence in the economy and that we could be sliding into a recession or we're in one now. So much going on, so many things to decide on. But the fact is, if you're a long term investor, really a lot of the stuff that we talk about doesn't mean a whole hell of a lot. So I think now is a good time to talk to you about things that do mean a whole hell of a lot. So, what means a lot? Well, let's talk about what could mean a lot. Have you updated the beneficiary designations on your retirement accounts and your life insurance policies? Okay. Have you updated your will? Have you gone through your credit card statement and eliminated any and all monthly subscriptions that you're not utilizing? Because we're back to living outside, back to the world, back to life. And all of a sudden, you don't need Disney app and the Paramount app, dare I say, even the Netflix app. See what you can get rid of, and be disciplined. It might not sound like a lot. Oh, what's the big deal? I'll do something to save $10 or $15 a month. It's not about $10 or $15 a month. It's about you becoming more efficient with your money, and that spreads to the rest of your money, to other facets of your financial life. So these are the things that you should go through. Have you been using your gym membership? No, still haven't been getting there? Cancel it. You can always go back. Believe me, your gym will be more than happy to take you back if you quit today. In fact, if you go in there and quit, they might even offer you a better deal, which means you might want to actually stay. So go ahead and work it out and see what happens. But let's focus on the important things in life. Are you consistently contributing every month to a retirement plan or some kind of investment plan? Do you have money in an emergency account? Do you have money in a savings account for planned expenses? These are the things that really count, not whether or not the stock market's going to be up or down over the next 6 months. Not to say, not that, excuse me, not that the stock market may or not be higher or lower over the next 6 months, maybe in a recession, maybe in a bear market. That's not that important. If your time horizon is 20 years out, 10 years, 15, 20, 30 years out, whether or not we go into a bear market today is pretty much irrelevant to you. But you're living in the moment, as most people are, and we let these short term things scare us. And that's what I want to try to talk you out of. You would think I spend a lot of time telling people what to do with their money, but I also spend a lot of time telling people what not to do with their money, like panic, like over concentrating in positions, like getting too heavy into meme stocks, for example, which a lot of people have been playing that game. So let's just take a look at the meme stocks that we follow. Okay. AMC, just about a low, down to 10. Wasn't this 25 or 30 a week ago? But it's down over 5%. All right. Let's going up in after hours, up 21 cents in aftermarket trading. But on the regular session, down over 5%. GameStop down to 34. Bed Bath and Beyond. Now, this stock was $25 recently. A big investor, took a big position in it, dumped all of his stock. Now the stock is down to 9, down another 16% today. Cost down to 8. Wendy's is down. Robinhood is down to $9. Wasn't Robinhood an $80 stock that couldn't miss? And what I don't have up here, which I wish I did have, is Bed Bath and Beyond. But what's happening is the crap, the junk, is getting crushed. And we need that cleansing to make room for better companies to move higher. You know what the companies are, the stocks you talk about all the time. Quality names. Some of them are blue chips. They could be blue chips of technology. They could be blue chips of industrials. They could be blue chips of healthcare. But the high quality names will recover at the expense of the low quality names. Why do I know that? Why am I so convinced about that? Because that's what happens. So that's about it. That's That's the day. That's the whole ball of wax. Quick show today. Let's see if we get a rebound tomorrow. Let's see if we could build on something tomorrow in the market. But right now, the word of the day is the Fed's going to keep fighting inflation. It doesn't want to make the mistake that the Federal Reserve made in the 70s, which meant the Federal Reserve raised rates to squash inflation, stopped, and then even cut rates occasionally when it got scared, when the Fed got scared that the U.S. economy would go into a recession. I think one of the good things about the Federal Reserve today is if it maintains a steady, strong hand. A steady, strong hand of the Federal Reserve gives investors confidence to buy, to own stock, and to send markets higher. And I think long term, that'll be much more important than a Fed that just gives up the ghost every time it gets scared that the stock market's going to go down a little bit. That's my story. I'm sticking to it. Thank you for watching, and I'll see you tomorrow.